All right, you all set? Welcome, everyone. Here's another Money Smart Show. Brian has a lot of information on today's market, right, Brian?
Yes, I do. Anything else you want to say, Matt, before I begin?
Yeah, so everyone join Money Smart Show on the YouTube channel. We have a lot more information there. And also subscribe to the Money, on this channels on the podcast as well. All right, thank you.
Okay, let's start off. I have to share the screen, so I'll get in there and do my window and the report. Okay, everybody see this spreadsheet? Can everybody see it?
Yes, yes.
Okay. Today's Money Smart Show on April 13th, 2024. We have a special guest today, Paul Mitchell. He'll tell us about saving and the benefits of saving. My name is Brian Johnson from the Moonlight Report. We'll enjoy the next half hour of talk. Here's a disclaimer. This talk on portfolio management and drawdown control is designed to educate investors to identify clues to the market based on stock market data. There is no guarantee that any signal will be timely or accurate. Investors should be aware that the analysis here is designed to inform, not avoid all losses that might be incurred. Past performance does not guarantee future results. And as to today's market, we're bearish. We just turned bearish on Wednesday, and here's why. What happened was the shortable correction of the four different signals we have, which the first one is the tsunami indicator. The second is the 50 new lows rule. The third is the accelerating new lows when the market starts plummeting. And the last one is a shortable correction, which just got signaled. Of all these things, rate of decline. Okay, the market is in a correction, showing a correction. Any number below 190, as calculated in the book before the bear strikes, is correction. Normalized news lows, less than, great. Okay, it's greater than 30 at the top and greater than 60 at the sell signal. Accelerating new lows has to be larger than at 40%, and you can look this up in the book before the bear strikes. It all tested true on Wednesday, so it's time to go short. As you can see here on the Russell 2000 or the IWM iShares Russell 2000, we have a couple of sell areas, and that's what happened. We have the market strength indicator, which shows how strong or weak the market is starting to turn down at this point. Okay, we have something else here called the confidence index, which has not flashed a warning here. But as you can see on the NASDAQ, this is the NASDAQ confidence index down here. There's the New York Stock Exchange. The New York Stock Exchange is much more much stronger than the NASDAQ down here, but they all work together. And right now, this looks like it's going to turn and trip. But here, the next chart is the real signal. The internals are falling apart. And you can see that New York Stock Exchange internals confidence index has crossed the moving average. And when that does, it signals a warning as to how strong the market is. Both NASDAQ and New York Stock Exchange have done it. These are not necessarily used for calculating the shortable correction, but it helps to have these things turn down when you're actually looking at what confirms it. Okay, here's a little snippet on the Moonrun report and how you can use it. It's $10 a month, first month free, and it's a bargain. The intent of the Moonrun report is to invest in proven portfolios to generate high returns. The idea is to sell out before bear market hits, which we feel like is the time to do it now, and you buy after the bear market is over. My track record, world champion 2008, calling the crash in September at that year, runner-up in 2009, and bond timer of the year in 2019. Fidelity account doing very well, around 20%. Since 2008, Holbert Financial Digest, number 2 per risk, number 4 per performance, past 12 months. Called the bear markets in 2008, 2011, and 2018. And the research began in 2005 when I discovered my first bear market indicator, the tsunami indicator. 7 portfolios that we can use: small cap, minor cap, mid cap, large cap, FANG-M, index funds, and ETFs. And we can go through and you can read the rest of this. I will not comment until it's time to go on. The advantage of this is that I've been able to sell out before the bear markets historically since 2008, and I've been able to get back in at the market when it's hit a low point. Examining the portfolios. Okay. First off, the small caps, back tested from 1999 to 2024 and in use currently too, almost a 50% compound average growth rate. Maximum drawdown, 36%. Turnover rate, not too bad, 354.67% per year. And at least sufficient shares to trade if anyone gets in. Now, I'll tell you a story about one other service I was with. They came out with a buy signal one time, and they had these lot of stocks that are strategies you could get into. Well, one of them was a very illiquid stock. It was at $3 and it opened the next day at $13. Everybody had piled into it. So they then raised the number of shares per day as a lesson. But that's what can happen in small cap stocks. And here's a chart of how it's done since 1999. Minor cap stocks. Back test from 1999 to 2024, 24.54% CAGR. And the turnover rate, 122, not too bad. And it looks at the between the small cap and the mid cap, okay? Here's a chart of the minor cap portfolio, how well it's done historically. Mid cap portfolio, back test from 1999 to 2024, 25% compounded average growth rate, and a maximum drawdown of almost 19%. That's not too bad at all. Turnover rate, about 100%. And so if you have a 10 stock portfolio, you trade 10 stocks on average per year. So it's in the mid cap range. And here's a chart of that portfolio, how it's done historically. Large cap portfolio, back test from 1999 to 2024, 23.87% compound average growth rate, and a turnover rate a little higher at 138, but not too bad. And it was well needed. I invented this in 2023, and it's done very, very well recently. So we have the chart of the large cap portfolio. Altogether, we have a 31.96% average growth rate. Maximum drawdown, when you put them all together, 20%. That is really outstanding, and you don't get hit too bad. Okay, large cap portfolio all together. Okay, we have this chart, how well it's done since 1999, back tested, and also it's currently being used. If you had $100,000 and you invested in one or all of these portfolios, in 10 years, looks like 100,000 becomes, with large cap, almost 900%, $900,000. That's 100. That's a big jump. Mid cap, almost $1 million. Same with the minor cap. Small cap, $5 million in 10 years. That's not too bad. And with the combined, that would be 1.6 million. Okay, at 15 years, how much $100,000 becomes if you have these performance rates? It would be for large cap at 2.6 million, 3.1 million for the mid cap. Minor cap is 3.1 million, small cap 38 million, and combined 6.4 million. Okay. And we have some snippets on YouTube. you go into YouTube and you go into the search bar and type in Money Smart Show. That's what you do. So the 2 minute, they're all 2 minutes long. 1987 to the present bear market calls and back tests. So I have 25 different shows lined up to describe the various different conditions and what I do in those conditions. So it's this commentary is very helpful, I think. Okay, today we're going to look at the large cap portfolio. No timing. Okay, I just ginned this up last week and I offered it on my website. It's not too bad. Stunning. 23.99 compound average growth rate. The no timing and sell and replace. 72% annual turnover rate. That's not too bad for that type of thing. Okay. And 50% maximum drawdown and 15.14 alpha. Alpha is just outstanding out there. Here's a chart of the portfolio from 1999 to the present. Buy rules, current ratio greater than 2.5 for at least 3 out of the last 5 years. That's the current ratio is overlooked. I think it's one of the most outstanding metric or factors or metrics you can actually use to pick stocks. It is really outstanding, especially for large cap stocks. Return on equity greater than 0. Surprise, surprise. You figure it'd be a lot over 15, but no. Return on equity just has to be positive. Gross margin greater than 5 for at least 3 of the last 5 years. That's usually you want to have something like 30 or 40, like Warren Buffett says. But no, I found that you just have to have a minimum amount of gross margin to keep it going. Free cash flow greater than 0.5 or 0.5% for at least 3 out of the last 5 years. Okay, those four things add up to big bucks. Okay, and they make analysts make Wall Street so complicated you can't figure it out. But these four deliver. They really do. Price greater than 5, at least 1 million shares traded per day, and we stick in a wash rule to make sure that it's okay. Sell rules. There's only 2 of them. I have a trailing stop, 25% from the top. Okay. And if sell of a stock drops 20% from the initial purchase price. So I put these into my portfolio. But if someone wants to buy a stock, I would recommend put 25% trailing stop right in there at the start so they can get kicked out at the right time. And anyway, so that's the scoop. Here's the ranking system. You can see higher is better. It looks like return on investment is a really good one. And it really absolutely a great part of the ranking system. So is free cash flow on the right-hand side over here. Lower is better for this. Higher is better for this. Asset turnover is part of it. A little bit of ROE, return on assets here, and they all add up to a really good performance. So that's the show. It's 12:14 when we have Paul Mitchell coming up. So I will stop sharing, and Paul, you can step in here and do your thing.
Okay, thank you, Brian. I appreciate it. Let me just get this queued up for you here. All right. Well, thank you. The same way, I will do a little bit of a disclaimer for you guys the same way. I'm Paul Mitchell. I am, and excuse the spelling there as I was rushing to get in the U and A combined, but Paul Mitchell. I'm a financial advisor and wealth manager for a company called Consolidated Planning based out of Charlotte. Um, and one of the things I wanted to talk about today was definitely savings and cash flow. I think that everything you said, Brian, is fantastic stuff. One of the things that we do that I do for my clients prior to even getting to that place where they're going to invest and make those kind of decisions. One of the things we do before long-term wealth building and designing that for my clients, we will make sure that we establish a system that allows them to be able to fuel those products. So some type of system in place to make sure that you're catching and keeping as much cash flow on your balance sheet as possible, and having a system that will also be able to power your investing in the future. Now, unfortunately, most people, it's not that they lack an intentionality behind investing, or it's not that they have any, these poor habits. It's mostly just like I talked about before, it's mostly just a poor system. So that is reflected usually in this national savings rate of between 1 and 5% here in the United States. So let me talk a little bit about what I mean by that and show you what I mean about how we can become better savers and actually fuel our investing a little bit better. So generally what happens for people is they earn an income, correct? They earn an income, whether it's from their employer or whether they're business owners, what have you. They earn an income. That income is used to go into their checking account, right? They usually have some sort of um, way that the income from what they earn goes right into their checkings account, and that checking account then goes to fund their lifestyle, right? So everything that happens, your car note, your house note, vacation plans, dinner plans, the kids soccer equipment, everything comes is funded from that checking account. So what is the result of that is that that checking account becomes a spending vehicle. There is nothing about your checking account in general that helps you to save better, to invest better, anything like that. It is really a vehicle that teaches you to become a perpetual consumer in a way, to, to fund everything that comes out of your lifestyle. In fact, if you were to save money, that becomes something that happens sort of by decision. You have to think about saving. You go to the bank, you set up a checkings account, and they ask you, how much would you like to save? For those people who actually have a savings account. And then you put money, and maybe that goes automatically in there. But if you ever want to increase your savings account or the amount that you save, still that becomes a decision. And this is where the crux of the problem is. Anytime you become a spender by default and a saver by decision, that's going to lead to problems even when we get to the investment conversations, right? Anytime you put spending by default up against savings by decision, spending by default will always win. Your lifestyle is now plugged directly into the income that you get. And one of the things that happens is many clients will tell me, Paul, if I made another 10 or $20,000, then I would become this better saver. And I will kindly and politely say, well, that's not really what happened. If you made another $10,000, for example, this year, the likelihood is that you're going to spend 9,900 or so of that money simply because of a system like this where there's no rails on your spending. So I want to introduce you guys to a better system that prevents this phantom drain over your income over time. This is a little bit better system. Same thing. The person makes $10,000 a year, right? We have what we call a wealth building account. Now, don't get caught up in that name because you're not going to find that at any institution. It's just something we call this intermediary account. And it's much like it could be a checking account, it could be a savings account, it could be a brokerage account, which is my preferred method to help my clients. And in this wealth building account, same thing. You get paid, whether you get paid from your employer, whether you pay yourself. This income goes into a wealth building account. From that wealth building account, then funds would be transferred to your checking account. In the same way that a checking account sends automatically money to your savings account without you thinking about it. So now your lifestyle is powered from this wealth building account. But let me show you the difference, what would happen. Let's suppose a person made $10,000 a month. That $10,000 goes into a wealth building account. You should know how much you need on a monthly basis to live, your living expenses. That's where that budget comes in. It becomes really important to know what that looks like. You're going to tell your wealth building account to send you that money. Let's suppose it's $7,500 a month or $8,000 a month. You make 10,000, it goes into your wealth building account. Wealth building account automatically sends you $8,000 a month. And now what happens? The same thing you did, the same spending that you did before via the system most people have now is the same thing. The difference is that other $2,000 goes to generate the other things. It goes to power your lifestyle. It goes to power your savings. It goes to power your investments. So $2,000 off the top goes to do things like cash. And don't get caught up in these because these could be anything. It could be emergency savings. It can be your investments. It could be funding your retirement account. It could be in purchasing real estate. Anything that goes 529 plans, whatever that is. But the key here is that instead of that first scenario where you were a spender by default and a saver by decision, now you become a saver by default because that happens first, a saver investor by default, and then spending becomes more of a decision. And the last thing before I turn it back over to you, Brahman, is that so even if you were to get, let's suppose this person got a $2,000 raise per month, right? Now you're bringing $12,000 per month as opposed to 10. You're still sending $75 or $8,000 to yourself each month, but now you automatically saved money because you in order for you to increase this amount, you'd have to go in there and think about that. Every decision that you make now that whereby you're looking to spend more money becomes something where now I have to think about, do I want to risk my investments? Do I want to risk emergency savings? Do I want to risk wealth building in order to spend more money? Now it becomes where spending becomes, again, a decision you have to make, and savings becomes something that you do by default. Okay. So just want to stop share there. And so that's really what I'm talking about, is just making sure that you design a system that allows you to become a saver investor by and off the top and from the very beginning, and not a spender by the beginning.
Thank you, Paul. Great speech. Really happy to see that. A lot of people go for 401ks because automatic off the top, that type of thing. And actually, it's a pretty darn good plan. You know, I was a grocery clerk in 2008 when I won the World Cup Championship. And here's what I did. I had $1,000 in my brokerage account, and I had paid for a $10,000 CD project that I had. My back was against the wall, but I didn't, have much money to work with. So I borrowed $15,000 from the bank to enter the World Cup Championship of stock trading, and I took first place. I was up 48% that year, and then I had a gangbuster year in 2009 in the stock market. I was up over 400%, and that cleared me from $1,000 to $100,000. Now, what you said about having a plan, I had a plan. I would not suggest that to anybody if they didn't do their homework. But really, it was stunning for me to actually make that much money. But investing without a plan is something that you need to have. And $2,000 off the top, like you said, is a good plan for anybody. Or actually, Paul, do you have a percentage that did you state as percentage that they should save, or just $2,000 off the top as far as I was able to clear?
Yeah, no, that was just an example for people. I think a percentage that we look at, what we call world-class savers. World-class savers are people who can save somewhere around 20%, right? About 20% of their income. If you can get to that level, we call you a world-class saver. Right now, the average for people is really somewhere between a 1% and 5% for most people. So it's just about having a plan to allow you to gradually. It's tough for people to go from, maybe if they only save 3% of their income, to go to 20 this year. That might be a little aggressive, right? You may not be able to do that. But What's the plan to get you there to gradually be able to get to a point where 20% becomes the norm?
Well, that's fantastic. Thank you. Okay, here's some questions I like to ask you. What are the most effective strategies for someone to save more money? What's the most effective?
I think just something like this, introducing a intermediary account or something. It's really about that concept of learning to become a saver by default. So the first thing is make sure for every dollar you're making that a percentage of that is going to you first and investing first, saving first. And what I mean by that, and something that's really important is it can't be by decision. You can't decide to do that. You have to make it. Most of us have to make that happen because it's what's going to happen by default. And so one of the best ways, as I've just talked about, is introducing this wealth building account first, and then letting that account send you your same money that you're going to use over the course of a month. Let it send you so that you are pretty much primarily working out of your checking account. But this wealth building account is account, usually I like it to be at a different institution. I don't want that wealth building account to be at the same institution that you bank at, because you could take the same debit card, go right in there and just pull it out anytime. I want this other account to be away from you, online, whatever it has to be, but somewhere where you're not thinking about it. You get paid, money goes in, sends your checking account. You're still doing the same things you do, but there is an account that's automatically building wealth for you and investing for you, like you say, automatically.
Okay, another one. What percentage of my income, which you touched on, should I save each month, and how can I realistically achieve this target without varying it too much? Maybe that type of thing. You want to make sure that your savings keep as savings and not just being another piggy bank for you to rob. That type of thing.
Yeah, and again, the same thing. Here's another example, like I said, of how that can happen, and you don't have to make really any changes generally. Generally, this year, I think average incomes of people increased. I want to say it's 4 point something percent this year from last year, right? The income went up with everything else. Now, so if your income went up by 4 point whatever percent, and that money is going into your wealth building account, and you're still sending yourself the same 7,500, you just did it by default. You didn't have to worry about making any changes, right? You did it by default. Every time you get a raise, every time you get a bonus, that money will be saved in the wealth building account, and that will be going to wherever you decide it's going to. So it can really, if you, once we have a discussion and this concept becomes a little more clear to you, that's one thing that you could do. But the other thing is, we always start with write a budget, and I think budget gets sort of this bad conception, bad connotation, but really it's just figuring out what money is coming onto your balance sheet each month and how much of it is leaving your balance sheet, and where can we find some savings there. What can we do? What are we doing? Do we have 2 or 3 memberships? Do we really need Netflix, Hulu, and Disney Plus when you really might not watch any of those, right? So where can we find some? And if we can't, then it becomes, as as income increases, how do we, not increase our spending?
Okay, here's a what are some common mistakes people make when trying to save money, and how can I avoid them?
A lot of time. Yeah, I think what are the common mistakes for that?
Yeah.
I think one of the things that people do that's sort of irrational is, um, I would say, I'm gonna go off a subject a little bit. So there are many people who will talk about things like um, immediately paying down all of your debt, which is fantastic. We do have a lot of debt. We do want to pay that stuff down, but I would say that we need to look at that in the context of wealth building. I do. Some debt is good debt, right? Student loan debt is actually viewed as good debt. House is good debt. I want to pay those things down, but I don't necessarily want to aggressively pay those things down at the behest of my wealth building. Does that make sense? Like, I don't want to not be putting any money away, not saving, because I'm busy putting all of my money towards paying down debt. That might not be the best strategy. So we need to look at things like that. Putting money in things like a savings account. Yes, everybody knows your savings account that you have at your bank probably doesn't give you a whole lot of interest on your money. So Is there another account, a high yield savings account? Is there some other vehicle, CDs, money market fund, money market instruments? Is there something else that might give you a better return on your money at this point, that might yield you more wealth? But those are conversations that you really need to be having with a financial advisor.
Okay, thank you, Paul Mitchell. We had a great show today, and I hope our guests today enjoyed it too, and everything functioning right. So, Matt, is there anything you want to say here?
Yes, we got 3 guests inviting here actually. So, any questions from the audience there? All right, so if no questions, please check out the exhibitor booth. We actually have a walkthrough tutorial in the main lobby. For those of you who might be interested in joining us, check it out. You got AI, social media booster, and also SEO, save you thousands of dollars every month. But more importantly, to join our smart community, money smart community, so that we can help everyone together. All right. Thank you. Thank you, everyone, joining us. Thank you, Paul and Brian.
Thank you.
Okay. Have a nice day, everybody. Bye-bye.
Have a wonderful weekend. Take care.
Thank you, guys. Take care.
Bye-bye.